we've got someone with a fantastic first name, although they're not great at spelling. Garret from Blue Chip. All right, so we got about 1 minute. So if you're here in the morning, you know that it's some time to kill, and I didn't know any stablecoin jokes, but I did ask ChatGPT. Most of them weren't very good, but one was close. So paraphrasing what ChatGPT came up with. Why did UST Luna Do Kwon name it Anchor Protocol? Because UST sunk like an anchor. Not bad, not bad. So for those who aren't familiar with Blue Chip, I'm sure you're going to hear much more about this during the presentation, but one of the more interesting questions lately has been, how do you actually come up with like a ranking system for stablecoins? We need a Moody's, right? And Blue Chip is provided. So are you ready to roll?
I'm just waiting for them to let me know when they're up.
All right, so
Yes.
we're about to hear about the Moody's of stablecoins. Blue Chip.
Thanks very much. Do I have a clicker? Great. Yes, so the world needed a stablecoin rating agency, and some of us were thinking this should have happened quite some time ago. It finally happened this week when our team of 3 at Blue Chip launched the first stablecoin rating agency. And so I'm going to tell you the story of how we came to be, and really what I'm also going to be telling you is how to create your own stablecoin rating agency. There are some basic economics that underlie this. That's the heart of the stablecoin. It's the heart of the Blue Chip rating framework is an economic safety approach. And so we'll walk through this step by step together. Do I have a page clicker? Is this it?
Yes.
Great. I'm trying to figure out which is up. Oh, up and down? Okay. Great. The heart of this problem is, the heart of running any stablecoin well is what I call the stablecoin temptation, which is that successful stablecoins need to be backed by a huge pile of wealth. This is what countries found out during the Asian financial crisis. You can have a well-run economy, you can have people who wear suits show up in meetings and say that your currency is stable. If you don't have a big pile of hard currency backing your coin or your own nation's exchange rate, you're vulnerable to a crisis. So every successful stablecoin in the near future will have to be backed by some kind of big pile of wealth. That means that equity-backed or algorithmically backed seniorage coins just are not going to work. The problem is that in real life, any big pile of wealth attracts people, whether inside or outside the org, who want to predate upon that wealth. They can be doing this for completely nefarious purposes, just people trying to steal, for people trying to run late-night votes on a DAO to try to raid the wealth. It can be people who run the organization saying, I should hire my friends because they need jobs. There's more than one way to misuse, to misspend the backing wealth of any stablecoin. And both in the recent past and I'm sure in the near future, we're going to find many ways in which the stablecoin temptation will apply to real-world projects. Another way to... Yes. Oh, yeah, sure. Great, thanks. I didn't know. Thanks very much. So it's these two parts. The two sides of the stablecoin temptation are the heart of any rating framework. First, are you going to be able to judge in a candid, clear way what the backing is of that particular coin? Second, are you going to be able to judge whether the organization has found a way to overcome the temptation for misuse and predation? Another way to put these together, wealth attracts predators of wealth. So in real life, banks have had to address this for a long time, right? Real world banks hold large piles of assets, whether they're loans or tradable financial assets. And when that happens, we know that there's going to be folks who will be tempted to misuse that wealth or to raid that wealth one way or the other. So bank regulators have a method that they've used for decades now, both in the US and around the world. It's known as the CAMELS rating framework. And the two key parts of this that matter for us, and I mention this as a reminder that real-world organizations have had to address the same issues as stablecoins for decades. So first, the A in CAMELS is looking at asset quality. Does the bank have a big pile of wealth? Second, the M in CAMELS, is the management quality high enough? Has the organization found a way to scare off the predators of wealth? So Blue Chip has found its own way to evaluate the stablecoin temptation, and we call this our smidge rating framework. It overlaps in important ways with Camel's, but it also pays careful attention to the unique nature of the world of cryptocurrency, the unique innovations of cryptocurrency, including decentralized algorithms. So the smidge rating framework, an acronym, looks at, to focus on the consonants today, stability, management, decentralization, and governance. S, stability, is really the stability mechanism underlying the coin. Does the coin have a huge pile of wealth underneath it? The S also does look at recent peg performance, but if the previous talk taught us anything, it's that a coin can be successful on 99% of the days, and yet that 99% rate of performance has no information at all about whether the coin is stable or not in a crisis. What we're preparing for in the world of stablecoins is not whether have you done well over 100 days. It's not even have you done well over 1,000 days. It's are you likely with a very high degree of probability to do well over 10,000 days, right? This is how we evaluate real-world currencies, not based on 3-year track records, but on much, much longer track records. So, does it have a big pile of wealth? Second, the M, the D, and the G in smidge are all basically looking at different forms of governance. And if there's one thing that the economics of the last few decades has taught us, it's looking at, again, something that came up in the earlier talk, that trustworthiness, trust are hard to come by in among real-world humans. And so large organizations need to have a variety of mechanisms. They're not just one or two solutions to this problem of trust and distrust. Each organization can find its own way to succeed at creating a trustworthy environment, and many, many humans over the centuries have found incredibly creative ways to fail at creating trustworthy environments. So this is part of the heart of any rating framework, is having something that is sophisticated enough to notice the many different ways in which people can succeed or fail at creating successful governance. There will be no one recipe for every coin. There will be no one recipe for every bank. There will be no one recipe for every financial system. There are different paths, and that means having a framework that's flexible enough to evaluate these many different paths. So, let me tell you how to start your own rating agency. First, the first step is to realize people have done this already. There are many rating agencies that actually work, right? There are many forms of grading that actually work. We all know that movie reviews have some sort of value. I'm sure that most people in this room have checked Rotten Tomatoes at some point to decide whether a movie is worth seeing. It's not that you worship the numbers that you see there. It's not that you treat them as infallible. It's that you treat them as a useful signal, right? And there are multiple signals you can look at, right? You can look at cinema scores, you can look at Rotten Tomatoes, you can look at audience views, you can look at box office. There's more than one path to evaluating that. And that's just something that's quite decentralized. That's a decentralized rating mechanism, right? More importantly, many people evaluate cars through a rating framework. And there are two major market dominant forms of this. I would say Consumer Reports and the J.D. Powers approach. Quite different approaches to looking at car ratings. Consumer Reports runs as a nonprofit. They buy the cars themselves. They check them out for a while. They ask their members of their group, of their organization, to evaluate the cars. Do you like yours? How has it run for the last few years? And the J.D. Powers approach is basically mass surveys. It's a for-profit organization. Both signals seem to be useful. There's more than one way to evaluate car safety. You might think, well, aren't these people all just bought off? Do Toyotas only get high ratings because they bribe the people at Consumer Reports more often and with greater dollar figures than everybody else? I mean, to even ask the question is to answer it, right? We all know that Toyotas do well in real life, and Consumer Reports is reporting the truth to us. So somehow that model works. Even the bond agencies, even the bond rating agencies, Moody's, Standard & Poor's, despite the criticism that came in with them after 2008, I still teach my students, I'm an associate professor of economics at George Mason, I still teach my students, especially in my graduate classes, just go look at the ratings and go look at the historical performance and accuracy of these ratings. AAA corporate bonds that have AAA ratings have lower default rates than A's. A's have lower default rates than B's. B's have lower default rates than C's. So even these for-profit organizations that are charging people for the ratings somehow found a path to tell the truth. So look at how those folks do this, and you realize, all of them need polyvalent. They need multiple tools at work in order to evaluate the product. And they need multiple approaches. There's not just one website they check. There's not just one algorithm they check. There's not just one trait of the bond or the car they check. Second, get the expertise to investigate these claims. Evaluating stablecoins means going beyond feels. It means going beyond memes. It means going beyond market share. It's not a popularity contest, right? It means having both the accounting and the economics expertise to evaluate, to know that you're asking the right questions and that you have the tools to evaluate them. So in the case of the Smidge framework, this means having at least one expert on hand who, with an accounting background, who can dive into reports, someone with enough knowledge of the cryptocurrency ecosystem to be able to determine on-chain holdings of assets that are credible versus those that are a little sketch. So again, this will mean going beyond, looking beyond the hype cycle to finding details that are reasonably credible underneath. Another way to investigate the credibility of claims is to decide that you're going to trust audits. Many people make claims about what they have in the real world, but not everyone has an outside organization with a long-standing, strong reputation come in and investigate those claims. The United States went through a substantial degree of accounting scandals in the early 2000s, but as it came out from that, what happened is that people decided to trust accountants more. Independent audits are a way to investigate and decide whether to trust somebody's claim that they actually have $1 billion in the bank. A lot of people can say they have $1 billion in the bank, but having a credible accounting firm certify publicly at the risk of committing strong financial fraud that that person actually has that $1 billion is worth quite a lot. Once you have this candid framework that you've come up with, in our case it was the Smidge rating framework, it's important to circulate it to others, people, both formal and informal advisors. This is what we spent about 6 months doing at Blue Chip before getting even close to rolling out all of our ratings. You ask people, like, are we asking the right questions? Do we place the right weights on different factors? Is our level of collateralization within the range of what's reasonable? Sometimes you might think that some things just get solved purely by economic theory or purely by common sense, but one thing about common sense is that it's good to have 4 or 5 or 6 people check out your common sense before deciding whether to believe your own common sense. So this is why sharing and bringing in a wide circle of advisors was important for us at Blue Chip, and I think it'll be important for anyone else trying to start a stablecoin rating agency. It's the unknown, part of the way you get rid of the unknown unknowns in your rating framework is by asking allies and even frenemies what they think of what you're doing. So that turned out to be very important, to just ask for people's candid advice. It turns out a lot of people have a lot of great opinions and they're willing to share them. So what you're going to find out after you've created your rating framework is that you're going to need a blend of economics and accounting. You're going to need a blend of monetary economics. You're going to need a blend of organizational economics, the study of how people create trust and trustworthiness inside of organizations. You're going to need some forensic accounting skills. You're going to need some cryptocurrency accounting skills. And these different skills, the people with these skill sets need to be able to work with each other. This is part of the evolution over the last 12 months at Blue Chip, was the 3 of us on our team learning how to translate our different dialects, the economics dialect, the accounting dialect, and the cryptocurrency dialect, and learning to go back and forth in a useful way so we weren't just staying in our own separate holes, but that we could each come together and find new insights. So this blend of economics and accounting turns out to be important, especially in the world of cryptocurrency, because people are, if there's one thing that we've learned from the great work of the late Robert Lucas, the Nobel laureate who passed away recently, it's that people in financial markets are particularly forward-looking, right? They're making choices today about what they think will happen in the future. And that sort of guesswork, figuring out what makes people trust an asset's ability to pay off well in the future versus what makes them distrust or fearful of an asset's ability to pay off in the future, means looking at the organization that created those assets and the team that's underlying those assets. Notice how much of this I've been able to talk about without talking about the details of either cryptocurrency programming or about liquidity pools. Part of what I'm looking at here with the stablecoin temptation is that if you have, we at Blue Chip are taking the position that to a large degree, if you have a good quality governance system in place, whether that's a centralized human-based management system or a decentralized algorithmic system, once those systems are in place, the invisible hand finds a way to make these things work. So management, governance turn out to be central. We can't be sure of what's happening in each and every transaction on each and every part of the blockchain, but we can be confident that if there are people in charge of the organization or a well-designed algorithm that's publicly visible, that those help solve problems that are even occurring at 2 in the morning. So, every organization that wants to create a rating agency, anybody who wants to do that, and I hope that there are many others who decide to do something like this, will have to make some forks in the road. They'll have to make decisions about what their rating agency how they will rate the coins. So one is a traditional accounting question. When you look at in traditional accounting, there are both measurable assets and unmeasurable assets, like goodwill or deep pockets. So when people measure the market value of some firms, you can see the market value of the assets that are on the books, and then there's something that sometimes gets called goodwill in traditional accounting. We economists might call it monopoly power or stickiness. Modern tech people would call it a moat. Those have some numerical value, those have some cash value to them, right? Those have some wealth to them. But it is so hard to measure that. At Blue Chip, we decided we are not measuring this. We're measuring the things that can be credibly measured. We put 0 value on goodwill. We put no weight on the moat. We put no weight on stickiness. It's too subjective. At the beginning, for us, this is not something that we're measuring. It has to be important to some extent, right? But when you have something that's important that you know you can't measure, that's something you say, this is for future research. Perhaps a year from now, 6 months from now, 2 years from now, there'll be a good, credible way to measure that. Another version of this that's more concrete is deep pockets. This is something that we talked about at the beginning at Blue Chip, that if a coin were backed by an organization that both cared about its own long-run reputation and that had enormously deep pockets, there should be a way to find a way to make that a plus factor. I mean, if a company with a market cap of $1 trillion, you might be able to think of a couple. If a company with a market cap of $1 trillion decided to start a, $5 billion stablecoin for some sort of small trading network, you would imagine that that corporation would have some kind of interest in being willing to bail itself out in a trouble just to keep its own reputation. So deep pockets, again, should be worth something. We don't have a concrete way to integrate that into our smidge rating framework at the present, but somebody could make a decision to make a more subjective, more judgment-based rating system and count that for a little bit of something, right? Deep pockets count for something. In the United States banking system, for instance, if a medium-sized bank is owned by a large bank holding company, the deep pockets of the bank holding company can be called upon to bail out the bank. The FDIC can say, hey, Megacorp, even if I don't care if you're a grocery store, I don't care if you are a shopping mall owner, I don't care what you are. If you own a bank and that bank goes bad, we can call in your deep pockets on this. So this means getting into questions of legality, questions of bankruptcy law, questions of FDIC receivership on some level. that matters in that world. There will be versions of that will apply to the world of cryptocurrencies. And it involves making legal judgments about worlds we haven't gotten to yet. Again, a rating agency that wanted to do more, I can say the words touch and feel, but touch and feel is important, right? The world of politics, the world of bankruptcy law is a world where people are going to be making judgments on the fly. And if you're rating a stablecoin, part of your decision is to decide when this coin gets into trouble, who will feel like bailing it out? Who will feel like saving it? Which investors will say, I will put my own cash on the line? These are judgment calls that will be made as versions of this decision were made over the weekend just a couple of months ago when it came to USDC, where people are deciding how much of their deep pockets are they going to bring to bear on these questions. Again, blue chips, we've decided that our smidge rating framework is sticking with things that are measurable, that are concrete. This is why assets matter. This is why publicly doxed management matters. This is why having your legal framework be set up in a country that has good rule of law and low corruption matters. So we're sticking with concrete measures. Of course, again, real life sometimes turns on those things plus other more subjective factors that are important. So before my time runs out, I should mention, should you downgrade a coin because the government threatens to shut down that coin? That's an important question. At Blue Chip, we decided we are rating the coin on its own terms, assuming it is allowed to legally operate. We let people know when there is legal action against a coin that's threatening. One of the coins that we give an A to actually has that, is under threat for that right now. But we're rating the coin based on whether it's allowed to work, whether it is likely to work. We're not taking the government threats to shut it down as part of our rating system right now. And everyone has to ask what their definition is of a failed coin. When your ATM closes down over the weekend, if your ATM is shut down or your bank is closed on the weekend, we don't say your banks have failed on a Saturday just because the teller isn't there. So in the 2008 financial crisis, a coin had a money market mutual fund only failed when it lost 3% of its value. So small deviations from a peg for a few hours, that is not a failed coin in our judgment. Other people might decide differently. We're worried about, at Blue Chip, we're worried about people losing a substantial portion, about massive failures of their peg. 2% changes are not part of our definition of a failed coin, but they may be for others. So the world currently has exactly one stablecoin rating agency. That is Blue Chip. We hope that others will join us, and we think that they'll end up starting with something like our smidge framework and changing it in small, perhaps large ways, adapting it to their own particular judgments. And that would be welcome, because what we need now is a debate over how to rate stablecoins in a clear, candid, and transparent way. That can only help the stablecoin ecosystem work better. Thanks.
Hello. I just wanted to peel back. So I generally really appreciated the structured approach that you're presenting for stablecoins. In particular, this idea of looking forward. For example, instead of looking at stability, looking backwards, you look forward. But I wanted to challenge the application of this framework to independent audits. So when you trust an independent auditor, you are banking on the past. When you say a trusted and reputable auditor is putting their reputation on the line to attest under law that you are presuming only based on past instead of looking forward. In my mind, any reliance, independent verification shouldn't have to rely on asking a third party to tell the world. It should rely on the world being able to independently verify, which is one of the benefits of sort of on-chain versus off-chain. And in my mind, that's why USDC and USDT are functionally the same, because they both rely on an independent auditor. Whether you trust that auditor or not is a judgment call based on the past rather than the future. Sorry. So I wondered if you had some thoughts on why you modified your framework in this respect.
Well, I had a professor in grad school, John Conlesk, who said, there are all these economists talking about rational expectations and forward-looking behavior. Bob Lucas among them. He says, the problem is that 100% of their data for looking into the future comes from the past. I mean, that's the only way human beings can learn, is we have to look at things that happened in the past. I write down models all the time that are perfect foresight economic models where I pretend you could look into the future, but that's just a guess based on the past. So I think it's actually too much to ask many people to be able to evaluate on-chain claims about assets. Part of what we do in our smidge rating framework is make judgments about that and report it to others. So if someone verbally says on their website, a normal person can look on-chain and see that these assets are there, how will a new user know whether to trust that claim? That's part of what we can do with the smidge rating framework, is say, we have looked at those on-chain assets and we believe those claims. But if someone's talking about off-chain assets, particularly when someone is talking about off-chain assets, that's where an independent audit is the best path forward in the world as we know it. So if someone says they have $1 billion in a bank account, I'm going to be looking for someone signing that document in a way that is putting their own making a legal statement that could be contested in court. That's the kind of statement I'm looking for. And again, I could say that's actually something about the future, right? You're making a statement that you will be drugged into court in the future if this is a lie or a material misstatement. Please.
Hi, Garret. Thanks for the talk and for launching Blue Chip. I agree with you, it's highly needed. And I'm really glad that we get the first stablecoin rating agencies calling for more already. You know, I think it's a very healthy behavior. So congrats on that. Wanted to ask a questions regarding governance. So for the stablecoins that have active governance in the one you support in the rating, is it envisioned to essentially, how do you account for the fact that what you have right now is a snapshot at present time? So you evaluated those coins now, but I think what would be very interesting with Blue Chip is to be able to see how this ranking evolve over time, depending on the governance decision. And if I can project into even the ideal situation, that would be even as those projects are discussing potential changes, kind of you guys hopping in and being like, hey guys, we modelize your envisioned change, and that would essentially have this impact on the rating, you know, be able to essentially help those projects guide those projects in those changes they make through the governance.
Yeah, that's a great question. We're going to be starting updating within weeks, right? Continually updating and renewing, not just the easy to check financial statements, but statements about the management and governance and decentralization scores of each coin. Updating those regularly is part of our process. We already, if you look at our ratings online at bluechip.org, you can see that for every coin that's not at the highest or lowest level, A or F, for everyone, A- through D, we actually explain the most important things that any coin can do to improve its grade. So that's real. I think we're trying to help people. We've already had some folks at running stablecoins reach out to us and say that they have information that they think is useful to us. So we think that conversation will continue in the future. And it's important for us to get the most accurate information possible. Being skeptical is an important part of being a stablecoin rating agency. I think you can all appreciate that. But information that can be accurately, independently verified, or information that's very transparent is very helpful to us. So,
thank you very much, Garret.
Thanks.